Welcome to the course. Today our topic is Forex players, market players or Forex players. We're talking about Forex, so let's have a look what's going on in the world. Now, there are major and minor market players in the market. So the first ones are, as you can see, the main players who actually play in the market big games. How much they contribute, and small and big play dynamics. Now, here I'm going to explain it to you. The biggest market play in the markets are the government of any country. UK, United States, Germany, Hong Kong, China, Australia, whatever. Why do they need the money? They need the money so they can do import and export. Right? They need to import stuff from the other side of the world to feed their people or make their economy strong. Now, what do? They look at the third world countries or the countries whose currencies are lower than theirs. For example, the British pound, if the British pound, 1 pound is equal to 10 RMB, a Chinese, then that means they're going to get good money of their, good value of the money. So they will get the goods cheaper. Now, if they need to export, everybody wants to buy European goods or American goods. But the thing is, it won't be easy for them because their currencies are really lower than the big country currency, like a pound. Like I told you, pound to a 10 RMB, if the RMB wants to buy a pound, then it's a lot of money. But they still do that. So in other words, every country needs the money. The other currencies, they want to change their currencies to the other currencies so they can actually bring the goods to their country. Either they're expensive or they're less, but whoever wants to do the import, they want the best quality and best currency for their money. And they want to buy more for less. So this is how the governments keep buying Forex. UK buying the dollars, UK buying the yuan, UK buying the yen, UK buying the euros, and vice versa. The dollar is buying the yen, the dollar is buying the euros, and dollar is buying all the other countries. So the biggest market player at the moment, not at the moment, always are the main governments. They are the best players in the market, right? Now, the second best players in the market are central banks. Now, central banks, what they do is the first central bank ever built was in the United Kingdom in 1896. That was the first central bank. Now, every central bank has 44 or 45 small banks underneath them. It controls all these small banks, like 45, I would say that, right? Now, how does it work is the smaller banks, for example, they have deposit of £100,000. That's only example. It can be £1 billion, yeah? I'm sticking to the £100,000. Now the smaller bank, the depositors are £100,000 and the withdrawals are also £100,000, right? But just in case what happened, the withdrawal goes to £200,000. Now, that's how the bank is going to manage that. What they're going to do, these smaller banks are going to look to the central bank. And the central bank made them promise that, right, okay, if you get short of money, we will help you out. Because central banks are very, very big, and they are the second biggest player in the market. They buy, sell Forex, they look after the small banks, and they help them out, and they keep them running. In central banks, there are a lot of banks like a HSBC, Royal Bank of Scotland, Stanley Morgan, the banks like these, they are the one who actually play a major role in the money market, like the Forex market, like the FX market, okay? Now, let's see the third one, the private and commercial banks. What do the private and commercial banks do? They do the same thing. They are under the central bank, right? Under the central bank. And what they're doing? They're just buying. They're buying currency. They're buying dollars against euros, or dollar GBP against euros, or another 10 bloody currencies, yeah? They're buying everything. They're buying everything. At the same time, they're also trading. They're trading in the market, right? And they're also helping the central banks to actually, make money. So they are the third participant in the Forex market, and they're doing quite well, and they're helping the central bank, and they're helping themselves as well at the same time. Now, what's happened after that? The financial guys, a financial institute, they have a lot of money. They have a lot of money, and they have big investors. They don't have their own money. They find the investors, right? And then they go out and they invest the money. Either they invest the money in the small banks, or they invest money in the central bank. But at the end of the day, they also supply money to companies as well, like company, which I will come in the next topic, with the companies. So that's the only way they can make money. Obviously, the financial institute interest rate is slightly higher, and their exchange rate is higher as well. Exchange rate is higher. And who are the financial companies? The saving banks, right? And then the commercial banks, and then the credit unions, and at last, saving and loan associations. Now, everybody, if you can't get a car from a main bank or main dealer or someone, so these people, the financial institutes, come in and they actually help you out, and people can get the money. All their possibilities, all their aim is to actually roll the money over, right? Now, after that, it comes to big companies. Now, big companies, what do they do? Big companies like Coca-Cola, BMW, Mercedes, and Toyota, McDonald's. They have branches all over the world, right? Now, the branches all over the world means they need a lot of cash. They need a lot of cash or Forex, right? So what's happened in the big, for example, let me tell you something. The Mercedes wants to buy parts manufactured in Japan. Now, their manufacturing from Japan is not going to be one time, is it? Not one time. It's going to be whole year. So what's going to happen? The Mercedes plan, for example, is for 1 year, yeah? They can't send the money for 1 year, because what's going to happen? While they order the Mercedes in Japan, the factory is going to manufacture the goods, and they might send something after 1 month, some after 6 months, and some after 1 year. So how are they going to control the Forex? What they do is, right, they do hedging. They make a plan and they fix a rate with the bank or a financial institute or whoever they are dealing with. And they say to them, look, we're going to import for the whole year and we want a fixed price. But if the GBP against the yen, for example, GBP against the yen, Japanese yen, was 8 yen for 1 pound, right? Now they will say no. Okay, the bank will say, okay, if you want the fixed rate for the whole year, then we will give you 10 yuan for the whole year. Now that means 1 GBP equal to 10 yuan, even if it was 8 today. What does that mean? Is now within 1 year, if the yuan goes high or yuan goes low, that doesn't matter. The bank will take the responsibility. bank is the main bank fix the price. Okay, it doesn't matter if it goes up or if it goes down, the bank is there happy to help them out. And they say, right, okay, doesn't matter, Mr. Mercedes or BMW, for the first year we fix your price to this, right? This is your fixed price, and we are going to work according to that. Now, this is how it works with the big companies. And what comes after the big companies? Now, after this, it comes a hedge fund. Hedge funds are another big aggressive company. Honestly, these people are really aggressive. They are the sharks in the market. Now, the hedge fund are very aggressive investors. Their only mission is to make profit. Make more profit than the bank and than the financial institute. They will lock exchange rate at the profit at their own choice. Right? They're not going to go for the bank. They're not going to go for any other investment company. Investment on behalf of their clients, investors as well as companies. Now, investors as well as company means that the big banks or even companies run after them. Why? Because their interest rate or their fixed rate is much higher. Now, the banks can also borrow money from them if they run out, and obviously they will pay them more. And even the big companies like Mercedes, BMW, anyone else, they will also borrow money from them, but on a higher interest rate, because their interest is double than the normal. So their whole point is to actually give a fixed price, but above the market rate. Yeah, above the market fixed price, above market rate. Now, if the market rate, for example, is 1.12, I'm just saying for example, yeah, the hedge fund will ask for 1.14 or 1.15. That depends on the time and how desperate people are money. So these companies, hedge funds, yeah, and these companies are really sharks, you know. And they find investors, the wide investors, the user leverage, the risk factors, you know, the free structure, and all these things what you see here, it all belongs to the hedge fund people. And hedge fund people are, well, in my word, I mean, they're not nice people, because obviously they're there to make money, but we shouldn't take it personally, because obviously it's a business end of the day, isn't it? So everyone is going to do that. But all you got to understand is, yeah, these are also another sharks of the market, which we really need to be very careful. Now, lastly, who comes in lastly? Mr. Goldfish. Wow, Goldfish looks really pretty, isn't she? Look. Nice and pretty goldfish. And who is she? Wow, I would do that again, you know, again and again, just to remind you. Who's the goldfish? Let's have a look who's the goldfish. Ah, we are the goldfish. We means me and you. Why we are the goldfish? Because the shark is out there to eat us. And you know what? A lot of people will tell you, trading is really good, you're going to make millionaire. Yes, you can be millionaire. But remember, you are the goldfish in the market. And honestly, there are sharks out there. Goldfish, Nemo, yeah? Well, Nemo looks pretty cool, but here is the original gold, the shark. The sharks are the banks, and we are the small traders. Who's Mr. Bank? Not only bank, all the other institute I told you, the big companies, the hedge fund, and also the investment. Now, companies. These are all short. These are all short. And you know what? This is what we are. This is what me and you. And this is, we have to be really careful. When they come in the market, yeah, they take the whole thing. And I want you to be this. You know what this is? This is a piranha fish. Piranha fish is very small, but bites back. Now, the bites back means what happens, you know, all these banks and big investors, they got billions of dollars to invest, which we don't have, right? We have a very limited account. Some of us, like micro lot, some of us use mini lots, some of us use lots, and some, like, even if we have £1 million account, we can't compete with these people, but there is a way of competing them. And this is what I'm trying to teach you. The grass is green at the other side, right? We are the small players in the market. You know, we have small accounts, okay? All the big boys comes in and do what they want, the market makers. And as long as we have small point, either is a 10K or 100K or 1 million. Okay, yeah, we're still a very small place. Big players comes after us, right? And he want to take us money, and they want to go to the wrong side. We are thinking that the banks and the hedge funds and etc., all the market makers, they will always mislead us. They will always say, if you look at the FX Street or all the website, they will tell you 65% people are in buy and 35% people are in sell. So what do you think the bank's going to do? Bank is not going to follow that. Bank's going to follow the opposite. Bank's going to say, if everybody is buying, no, I will sell. And the bank will come down and take all your money. They will hit your stop loss and they will say, bye-bye, small fish. Okay, your target was 100 pips, but you can't even have 10 pips, and I will see you later. So what they will do, they will get rid of you. So all these big banks and all these big market makers, make sure you don't follow them. Because these people, they want you to lose money. If the market is saying go up, yeah, they will go down. If the market is saying come down, they will go up. Because they want to take your money, and that's the only way they can take your money. And this is, we have to be very, 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 very careful about this. It all depends on supply and demand. And the supply and demand, no one knows better than bank. Now, having said that, in coming lessons, I will show you what to do and what not to do, when to invest and when not to invest. Now, this is where you need to learn a lot of things before you can, lot of things. Let me underline that. Okay, lot of things before you can take a trade and before you can beat these people. Beating shark is not easy. And let me tell you something, the grass is green at the other side, but when you go near the grass, yeah, it might burn your hands. What I'm trying to say here, my brothers and sisters and my friends and folks, that do not fall for it. I don't want to show you that this is hunky-dory and the grass is always green and you can become millionaire in no time. You have to understand you're fighting the sharks and you're a goldfish, and you need to remember one thing, that you need to know how to fight them. And once you understand, then you can be a very good trader. And I wish you all the best and have a lovely day and a happy trading. Thank you very much.